folks at this conference, and just generally speaking, the first question that they've posed to me is, Aron, where are we? Where are we in this cycle? Where are we as a sector? And my response is, fourth inning, whether we're in the top or the bottom, couldn't tell you. I could tell you that the pendulum has swung.
Welcome to Season 8 of Bridge the Gap, a podcast dedicated to informing, educating, and influencing the future of housing and services for seniors. The BTG network is powered by sponsors Align, NICMAP, ProCare HR, Sage, Hamilton Captel, ServiceMaster, The Bridge Group Construction, and Solinity, and produced by Solinity Marketing.
Bridge the Gap in 3, 2. Welcome to Bridge the Gap podcast, the senior living podcast with Josh and Lucas in a beautiful spot here in Arizona at the Arizona Biltmore. Wonderful ASHA meeting. And we have a great friend and returning guest back to the program. Welcome, Aron Will. Welcome to the show.
Thank you. Thanks for having me again.
So glad to have you back. We love getting you on the show because I see you as like this pilot that gets to see the dashboard of the entire industry. And you got like check engine lights going, and you got like altitude, like all this stuff is going, and you're getting kind of a high level view of all of these different things. And it's so fun to pick your brain about where is the industry, where are we going, what's the new administration's effect on the next couple of years. There's so many things to talk about. Let's get rolling.
First thing, appreciate that. A lot of folks at this conference, and just generally speaking, the first question that they've posed to me is, Aron, where are we? Where are we in this cycle? Where are we as a sector? And my response is, fourth inning, whether we're in the top or the bottom, couldn't tell you. I could tell you that the pendulum has swung. If you think about 2023, and I compare and contrast fourth quarter 2023 to fourth quarter of 2024, and you just think about equity capital in the sector. Market participation was 25-30%. Market participation is now probably 70%, which is huge, right? If you think about that in the context of weight of capital in our sector compared to a more mature space like multifamily, we try not to be so myopic, right, as a discipline head within our organization, and compare and contrast, right? And in the processes that we had going on in the fourth quarter of last year, our multifamily brethren saw, with the interest rate volatility, more specifically the 10-year running up to close to 5%, it wasn't lockstep, price retrades for deals that weren't hard, but it was pretty close, 2, 3, 4, 5% retrades on deals, right? Because more or less the composition of investors in that mature asset type is the same, right? So interest rates have a material impact on your valuations, right? If 3 to 5% additional capital, which is what we saw, almost like a light switch, third, fourth quarter of last year, and more specifically core and core plus capital coming into our sector, right? In other words, in senior housing sector, if you had a stabilized asset for the longest time in our space, it was a mismatch because every single virtually institutional investor wanted value-add or opportunistic returns, right? And alas, we worked on some transactions, one in particular, very high dollar per unit, low cap rate, deal was about $250 million deal. That was kind of set the stage for, the industry for coming at it for a position of strength, whereby there's core and core plus capital chasing seniors, and the weight of capital in the sector in the fourth quarter offset that rise in interest rates, which was fascinating. And we didn't see that in virtually any other real estate asset class, right? And so I think the reason that is, right, and that the reason that there's a lot of sophisticated asset managers now that are entering our space, if you look at the composition in the bid sheets today, you have some of the usual suspects, right? But a subset of those folks are, somewhat jaded, right? If they had large portfolios of seniors and they got impacted during COVID, right? Because they take deals to IC and say, deal looked like this, and this in our portfolio. How do we make that work? And the answer is, vintage matters, right? And COVID happened and so on and so forth. But the fact of the matter is a lot of institutional investors today want exposure to alts, okay? Senior housing is at the top of that list. If you talk to these folks, yes, it's data centers, student, but senior has a real place. And if you look at the demographics and the performance, right, today, you look at the supply picture at 1% or less, we're getting to like GFC levels, right? 2026 and beyond, it's going to be very, very hard to satiate the demand function. You have to build it twice the peak levels that ever's been done in our sector, right? A lot of people are reading the Green Street reports. A lot of people are reading and looking very closely at the NIC data and kind of leaning into our sector, right? And a lot of people are saying, even people that solve for mid-teens returns, saying with realistic underwriting assumptions, maybe it'll be a 17. And I think they're right. So there's a way to capital now in our space. And there's a trickle-down effect, too. The interesting thing is not just on the equity side of the market. For the longest time, just starting, the bottom up, the banking market was effectively shut down, right? And in particular in our sector, given the COVID impact, right? Unless there was a depository relationship, and it was a conforming loan, which typically meant 115, 120 debt service, which on a 535 SOFR plus a 3-something spread on pay rate on a 30-year amortization schedule was a very high bar, so to speak, right? On a T6 look back, not a lot of deals penciled, right? That's a very, very high debt yield to make it work in a bank context, right? Today, fast forward, there's a subset of banks that are starting to look at deals at 105, 110 with fresh equity in, for institutional sponsors. We're starting to see the first wave of those deals, getting financed. There's infinitely more liquidity in the debt fund space. We've seen a spread compression in that space as well, especially in the larger deal. And we've got deals now ranging from, 35 million to close to 300 million that we're marketing on the debt side, and we've seen 50 to 75 basis points of spread compression. Again, from October, November to the present, like very, very rapidly in our sector, because people are looking at seniors going, multi's extraordinarily compressed. I can still get, 75 basis points of yield premium, for these deals. I like the operating fundamentals better in this sector if I make my bets right with the right, institutional sponsors and operators and so forth. And so we're kind of seeing a lot of positive trends, across the board. It's a very, very fascinating time in the market. You spoke to the administration, just touching on that for a moment, and obviously that has a huge impact on hospitality, any heavily staffed asset type. We'll see what happens.
Well, so Aaron, that's a lot, but I heard a lot of positive things for the space. You've been with the industry so long, you've seen the ebb and flow, the highs, the lows. From a forward-looking standpoint, with all that, even hearing our partners at NICMAP, a lot of positive data trends that support what you're saying as we talk to them. Do you have any reservations or cautions or kind of words of wisdom for those that are going to potentially be hitting some high growth spurts over the next 24 months or so as new capital's coming into the market, to kind of like stay disciplined, or things that we should really be cautious about optimistically as we're moving ahead in a favorable direction?
Those that have been exposed, if you look at the last cycle in COVID, a lot of people have a misconception in our sector that it was just the mom and pop operators, that didn't have the right playbook, policies and procedures, so on and so forth. That's not accurate. There was a lot of operators in our sector that were 30, 40, 50, 70 properties that didn't have the underlying infrastructure either, or that were pretenders from a different asset type that got in and were not really tried and true senior housing people and so forth. So, the biggest piece of advice that I would have for institutional investors in the sector is people think senior housing is, when they come into it initially, is a real estate play, and it is. But it's also an operating business attached to real estate. And picking your partners and picking your partners right is, of critical importance. So those, as the operating fundamentals are, improving quarter over quarter in a very demonstrable fashion, that's the thing I see. Some of the things you're speaking to coming out of the GFC as an example that crushed the sector, like overdevelopment, overzealous developers in low barrier to entry markets that tend to get overdeveloped in every real estate asset type in every cycle. That happened in our sector.
Yeah, absolutely.
And with abandon. The gestation period of development now, the cost of development, most development, unless it's super high barrier to entry, very high rent, kind of stuff, it just, we're active adult in that space. Commodities, more specifically wood frame construction, has gone down versus steel and concrete, which is not. Makes a little bit more sense. But still, it takes 18, 24 months to build it. It takes 2 to 3 years to lease it. It's so far out. Again, it's in the next 24 months, just to address your question head on. I don't see that as a risk that's imminent, candidly. Development specifically. Labor. That's a big thing. That's normalized. Labor challenges. There's various things that impact that market. Some markets are still more challenged than others from a labor perspective. Some we're paying attention to. Insurance, that impacts all of real estate, and obviously what happened in California and LA more specifically, people pay attention to things like that, but that's not something that's so specific to senior housing per se.
Another question I had, so I've heard a lot of talk now that it seems like cash is coming into the market. I have heard a lot of, I would say, opportunistic, very successful developers in other verticals, real estate players in other verticals. They see the demographic. They know the numbers. They have studied what's the boomers are about to enter, and they're seeing the opportunity to not develop right now, but to go in and just really bullish on acquisition. And you start looking at a lot of the assets that are aged assets, and they're thinking, hey, we're going to come in, we're going to put a little bit of lipstick on it and somehow have a different result. Do you have any words of wisdom or caution for people when they're sizing up, these assets where they're going to deploy a lot of cash and build out platforms, how we should be approaching the aging asset and the repositioning of that for kind of next generation senior housing? Do you have any thoughts on that or words of wisdom, caution?
Well, there's two types of repositionings I think maybe you're speaking to or alluding to. One is non-purpose built, like repurposing of hotels and hospitals and things of that nature. And what I've found personally, having worked on, unless it's extraordinarily precious real estate, and you get it for free, it's invariably much more expensive, much more complicated, and there's a stigma attached to that. Sure. And 95% of institutional investors on the flip will not touch it if you go to monetize it. So you better be prepared to keep it forever. Right. If you're converting non-purpose built stuff. So I think that's just fundamentally a bad investment strategy, personally, for my own pocketbook. Now, repositioning older senior housing, purpose-built senior housing assets, that's a different kettle of fish. A subset of those assets, in my opinion, are functionally obsolete. A subset of those assets are not, though. Have good bones, stand the test of time, good underlying real estate, generation one or generation two, late 90s, early 2000s kind of vintage, right? Where you can put CapEx into them, and they may not be, commensurate with the Class A plus comp, but there's a place in the market for those deals, right? And those are not all forgotten, assets.
Yeah.
And another thing I didn't speak to, what do people gravitate to early in the cycle? They gravitate toward low-hanging fruit in every real estate cycle, okay? What does that mean in senior living today? What is low-hanging fruit? Low-hanging fruit is full continuum of care, ILAL memory care or assisted and memory care, major market, new vintage, typically 2010 to the present. In some cases, some investors say it's got to be even newer than that. Major market, 80% or more leased, a little bit of meat on the bone, don't have to effectuate, a huge heavy lift. And they love that story. And those deals, a lot of those deals existed. Well, we've run through a lot of those deals. So what's going to happen next? People are going to go to the secondary markets. People are going to buy assets that have some age to them. People are going to go into tertiary markets eventually, and already starting to do so at the appropriate pricing, so on and so forth, right? This happens in every real estate asset class in every cycle, and it's happening now in senior living, right? So to your point, there will be and there is a place to reposition assets of this type. It has not been the product du jour or the strategy here today because there's been so much low-hanging fruit in the new, it was a COVID baby, we have a debt maturity or a partnership issue or an operational issue or a fund maturity or some combination thereof, and people were able to seize those opportunities. Well, a lot of those opportunities are, have been run through, and now they're on to the next thing. It's not going to be as easy, right? For those seeking, high-yielding opportunities. So I do think that there's a place in the market for that, and there's going to be some great opportunities. Here to date, it's been a contrarian investment strategy to reposition kind of older and buy those assets, though. I think it's an interesting one, though, and I think it's an interesting one to do now before the field is a lot more crowded, quite frankly. But purpose-built versus non-purpose-built is a huge distinction, in my opinion.
Well, and I think that's a great distinction you so eloquently put for our audience. Great wealth of information as always, Lucas, with Aron. If we could literally have you sit down with us every quarter, what a wealth of information and appreciation to our audience.
So we got to get Aron to his next meeting. But before you go, final words on interest rates, 2025. Give us the crystal ball.
That's loaded, huh?
My crystal ball's as hazy as the next guy. I think people believe the 10-year is going to be bobbing around between 4.5 and 5. I think, the closer to 4.5, the better, than 5. I think we sit at 4.56, 7 today. I think so long as there's stability, that's better. Obviously, people are expecting SOFR to be cut, 100, 125, potentially more, which would be wonderful, and make floating rate bridge and construction much more manageable, today. What's interesting, MBS, spreads have come in, which is good. So long as that continues and there's stability in spreads and they don't gap out, the Treasury is going to be where it's going to be. I don't think that's going to compress a ton. At least the people I pay close attention to, the economists that I pay close attention to that are a heck of a lot smarter than me. So.
Well, great information, Lucas. Aaron, thanks, man, for sitting down with us. What a great time with you always.
Yeah, we always appreciate Aaron giving us his depth of knowledge. And if you enjoyed this episode, Aaron has been on a couple of times before. If you want to kind of dig back into the archives here on this, we call this the Masterclass series with Aron Will. You can go back to episode 266, for instance, and check him out there. Aaron, thanks for your time today.
Very welcome. Thanks, Chance.
For our listeners, go to Bridge the Gap, btgvoice.com, and you can check out this content and so much more. Connect with us on LinkedIn. And thanks for listening to another great episode of Bridge the Gap.
Thanks for listening to Bridge the Gap podcast with Josh and Lucas. Connect with the BTG Network team and use your voice to influence the industry by connecting with us at btgvoice.com.